on the Holy Blossom Temple. And if you didn't hear that note, we are being recorded right now. I'm very pleased to welcome you to our very first webinar on legacy giving, entitled Giving Smarter, Doing Well by Doing Good. We have a wonderful panel this evening, and our participants are David Baskin, Mark Halpern, Jessica Chitley, and Daniel Wilson. I'm going to just briefly tell you something about each of them, and then when they go, they will hand the mic over to the next person. So our first speaker is David Baskin. He is a longtime Temple member with his wife, Joan Garson, and a former past president, as well as his wife, Joan, who was a former past president. David is the president of Baskin Wealth Management. He has built Baskin Wealth Management to serve the needs of families, recognizing the intimate connections between parents, children, grandchildren, and siblings, and viewing money as a tool to help family members achieve their goals. Our second speaker is Mark Halpern. He is the founder and CEO of wealthinsurance.com. Mark is a certified financial planner, trust and estate practitioner, and a master financial advisor in philanthropy. Mark and his team provide tax-advantaged insurance solutions, working closely with accountants, lawyers, bankers, and other financial professionals to provide comprehensive estate planning solutions for their clients. Our third speaker is Jessica Chitley. She is a partner at Bales Beal LLP and is also a member of Holy Blossom Temple. Jessica's practice is devoted to estates, wills, and trusts. She advises clients on tax minimization strategies and drafts wills, trusts, and powers of attorney. Our last speaker is Daniel Wilson, who is also a congregant, Temple board member, and on the finance and audit committees. Daniel is a principal in the tax department of Siegel LLP. His experience includes tax aspects of sale and purchase of businesses, cross-border taxation, estate planning, and personal and corporate tax planning. So I'm going to introduce David to start, and when he is finished, if he would pass the mic over, as it were, to Mark, we can save some back and forth.
Thanks very much, Allison, and good evening, everybody. What I want to talk about tonight is giving appreciated securities to charities, and of course, in particular to Holy Blossom, as a way of meeting your charitable pledges or commitments. Because we've been in a fairly protracted bull market, depending on how you measure, maybe since 2010, or if you have more recent memory, maybe the last 11 months, a lot of people have stocks that have gone up a lot. If, for example, you were lucky enough to buy one of the so-called FANG stocks like Facebook, Apple, Amazon, Netflix, or Google, you might be sitting on a gain of as much as 500 or 1,000% on that stock, which is great until you come to sell it, of course. And when you come to sell it, you find that you're going to share with the government because of capital gains taxes. Now, luckily, the government has given you an out. If you donate a security that's gone up in value to a charity such as Holy Blossom, the capital gains tax is waived in full. So imagine that you had $100,000 worth of Apple stock, and because of your brilliance or your investment manager's brilliance, you only paid $10,000 for it when you bought it a few years ago. That's a $90,000 capital gain. If you're in the top tax bracket, that would normally be taxed at around 25%, and you'd be looking at a capital gains tax hit of around $22,000 or $23,000. Takes some of the fun out of selling the stock, of course. But if you donated your shares of Apple to Holy Blossom, the government would waive that capital tax altogether. And in addition, you would still get the full value of your corporate donation, which, depending on your tax bracket, might be worth about 50 cents on the dollar. If you add the two things together, you'll find that you get a tax advantage of over 70% of the value of your gift. To put it another way, Holy Blossom gets $1, but it only cost you 30 cents. So let me take you through some of the mechanics so you'll understand exactly how easy it is to do this, because it really is very easy. The first thing you need to do, of course, is make sure that the securities you want to donate are in a taxable account. This doesn't work if you donate securities that are, for example, in a TFSA or an RSP or a RIF. It has to be in a taxable account for this to work well. Number two, you're looking for the security that you have which has the largest percentage gain, not necessarily the largest dollar amount, but the largest percentage gain. That's where you're going to get the most bang for your charitable buck. Number three, you want to find the account that you own that is at the highest marginal tax rate. You might have, for example, a trust for your children. You might have a company, if you're a doctor or a lawyer, you might have a professional company, or you might just have a regular non-registered account. All of those accounts have different tax rates. You want to find the one that has the highest marginal tax rate, and that way you're going to get the very best benefit from your gift. So you've gone through this exercise, you found that your shares of Apple are in a personal account in your own name, that they've gone up 900%, which is wonderful, and that you're at the top marginal tax bracket. So this is the way you're going to do it, and it's going to work for you. So all you have to do at that point is either call the Temple office or go on the Temple website, and you'll find the form needed to donate charitable securities. And I haven't looked at my Temple dues packages here, and I don't know if there's a form in there to help me donate by way of appreciated securities, but it's easy to find the form. When you find it, all you have to do at that point is decide when you want to pull the trigger and send in the form. When you do, your broker will transfer the securities to the Temple's broker, and you'll get the value of the shares on the day that they're received by the Temple's broker. Of course, you don't know exactly what that is, but in general, it shouldn't be too far off because it doesn't take long. That's the value that you'll get for your tax receipt. When you come to do your tax bill at the end of the year, you'll get your tax receipt, and of course, you will not have a capital gain. Now, there's one added feature, an added benefit, if I can. If you happen to give these securities from a corporation, something called your capital dividend account will go up because of the capital gain, even though you didn't pay any capital gains taxes. And that will allow you to pay a tax-free dividend out of your company. That's kind of a third benefit. So to summarize, this is a great way to pay any amount that you want to a charity, even a small amount. I have clients who've fulfilled pledges to the UJA, for example, as small as $2,500 by giving, 25 shares of a bank, for example. You can fulfill pledges of any amount. There's no limit on the amount that you can give. You might save as much as 75 cents on the dollar. It's easy. It's one form requiring 2 minutes to fill out, and it can save you a lot of money. So I think it's a terrific tax savings tip. We all pay Temple dues. We all pay our pledges and our amounts to other charities that we're devoted to. This is a great way to do it after we've had the benefit of this terrific stock market over the last year or 10 years, depending how you measure it. So that's my tip for the night. And with that, I'm going to turn it over to Mark.
Sorry. I was just saying, David is spot on. 99% of people who give money to charities today give cash, checks, and credit cards. And that's probably the most inefficient, cost and tax inefficient way to give. I'm not suggesting you stop, but there are way better ways if you have stock mutual funds, ETFs, or segregated funds. So I highly recommend that. I'm just going to put up my, can you all see that now? Can you see that? Fantastic. Well, it's really great to be here. COVID, I hope everybody's been safe. It's been a very trying year for a lot of people. I can tell you for myself, it's been one of the busiest years of my 30 years in professional practice. Why? Because people are much more aware of their mortality, and that means they're also aware of their incompletions, financial incompletions, when it comes to estate planning, wills, powers of attorney, insurance, and also creating a legacy for their family. They may have been givers in the past, but they've never really actually created a legacy for their children and grandchildren. And I call that going from success to significance. And I'm going to share with you some ideas that have worked with a lot of our clients, and hopefully it'll help you in terms of being better at giving and being more generous as well. Of course, speak to your professional advisors before attempting any of this. So the government, is trying to make our life much easier. Apparently, they're going to be introducing a new simplified tax return with one question on it. How much did you make? Send it to us. Of course, we joke around, but we know that taxes are on the way. And where do we see today's reality? Taxes are going up. The last budget was more like presents under the Christmas tree, depending on who you are. And we're going to see possible increases in tax with wealth tax, an inheritance tax, a tax on principal residences, income taxes going up. That makes it very challenging for us to find places to save our taxes for our family or for charities. Donors are getting older. So unless we sort of get to people, or you start doing things sooner, that may be a great loss of an opportunity for your family and also for the charity. We're in a misinformation age. People are going online for information. We still need professionals to talk to. I'm sure you've all heard of the famous line from London Life, Freedom 55. Freedom 55 today is when your youngest child is 55. I'm not kidding. Think of it. Your kids are getting out of school, trying to find jobs, trying to buy real estate with loans and debts and whatever. So we have to take care of our families first, but we have to also look at our social responsibility. And the good news about that is people are seeking meaning in their lives much more than ever. Now, I started 30 years ago, but my real start in the business was 47 years ago. And that's when my father, blessed memory, died of a massive heart attack at the age of 50. I was 11. I was the youngest of 4 boys. And my mother, who was 48 at the time, had to go back to work to support our family. Why? My father was a busy engineer. There was no will, there was very little savings, and there was no life insurance. So it was very hard for us. Fast forward, I worked with some of the most successful business owners and entrepreneurs and wealthy families, and you would think they'd have everything all organized and together. But it's not true. They're so busy looking after everything and everyone else, they don't always have those things looked after. So it's really important that people, as part of what we're doing, have a comprehensive picture. This is the process that we take through with clients, just making sure that the financial architecture you started with and the furniture lines up with your current financial architecture and furniture. And as you can see, the very last subject here is charitable plan giving. And that's always something that we speak about. And the key here is that you do have control over your legacy. Most people will accumulate assets, and at some point in time, they're going to actually start accessing some of that money, or if they're really good investors, chances are they're going to have more money when they die than what they have today, which means that, unless they blew all their money in a penny stock or started spending frivolously, they're going to be the custodian or trustee for the next generation. But what they don't realize is that they're partnering with the tax department on that money. So if there's a way to see what kind of never spend money there is that you're paying taxes on, then you can use that to preserve your estate for your family or look at charity. And that's why we have lots of taxes. Listen, taxes also help the social fabric. A lot of people don't realize what taxes look like on all of these different assets. In Ontario, if you have registered assets, the tax, if you have any investment real estate or private equity or shares, as David said, 25% tax on that in capital gain. Anywhere between 47 and 70% if not properly managed. And then there's passive income, probate taxes. Daniel, I'm sure, and Jennifer will talk about this. So the key thing that all of us need to know is that we all have 3 possible beneficiaries to our estate. You have family, you have the tax department, and you have charity. And each of us can pick 2. Which 2 would you pick? Most people would pick family and charity. And with proper planning, there's a way to be remembered for giving a lot of money to the charities that you're passionate about, as opposed to leaving a big check to the tax department. What we do is there are 2 types of givers. There are people who just have the DNA of wanting to give, and clearly the people on this call are that type of person. And then there are people who maybe don't have the DNA to give. But when they find out how much money is going to have to be paid in tax, suddenly even those people become what we call accidental philanthropists. And the people who are already giving realize that they can be even more generous without being Bill Gates or Warren Buffett. And I just want to here's a top list for us of what we call best accidental philanthropists that we see are opportunities for everyone to help yourselves and your families with a legacy. First of all, in Canada, widows, divorcees, and singles are biased against, because unless you have a spouse to roll over all your assets to on death with a tax-free spousal rollover, when you die, it's considered as if you sold everything at market value at that moment, and the government's going to want their handout for a percentage of your good fortune. Anybody who's sold a business or will be selling a business or investment real estate or appreciated securities, that's the year you're going to have your biggest tax, but it's also the year you can be your most generous and get the money that you donate back to your family. If you've done an estate freeze or will be doing an estate freeze, there's ways to reduce those taxes on those preferred shares and create a lot of good money for charities you care about. If you have a foundation or a donor advised fund, also there are great ways for you to create transformational wealth or charitable wealth there. As David said, if you have a tax bill in April, donate appreciated securities in the fall and be able to offset up to 75% of the tax due in April. If you have an old life insurance policy or you want to take out a new life insurance policy, make Holy Blossom the beneficiary of it. You can actually donate a policy that you might have sitting around and get a charitable receipt for the market value of that and create a great gift for something that you're really not paying too much attention on. If you have an estate bill on tax bill on death, great ways to give charity on death. If you've left money in a will, another way. There's ways to amplify that gift. So it really requires a conversation. And the simple math is this: every $2 you give to charity, you save $1 of tax. $2 to charity, $1 to tax. And whatever you do give to charity, you can offset 75% of your annual tax bill. But on death, anything you give to charity can be used to offset up to 100% of your estate taxes, plus you can include the year prior as well. So it's a very, very powerful way of converting taxes to charity. We don't have a lot of tax shelters left in Canada. Other than your principal residence and TFSAs and lottery winnings, tax-exempt life insurance is one of the other four that fits in the category that, everything else you have, there's somebody from the CRA with their handout that wants to share in your good fortune, except for these four. So I want to talk a little bit about how life insurance can work for you in creating a substantial gift for Holy Blossom. First of all, not all gifts are the same. Here's an example of somebody who wanted to give away $1 million of $1 million donation. And the assumption here on the left column is if they gave cash, or if they gave public shares with a zero cost base, or if they gave flow-through shares, or they gave life insurance. As you can see, cash is the most inefficient. It costs you 50 cents for every dollar you donate. If you gave the shares, it would be about 23 cents per dollar. If you use flow-through shares, depending on what province you're in, they can cost you anywhere from 5 to 15 cents. And life insurance can cost you 12 cents to leave a substantial gift. So it's something that definitely deserves attention. And I mentioned before, the biggest challenge we have is with widows, divorcees, and singles. I meet so many people who don't even realize that on their death, their RIFs are going to be taxable. So if you have $1 million and you have no spouse, your family's only going to be getting $460,000. So if you're generous, there are ways for you to be able to plan to leave your kids $1.5 million with planning and still get $1 million to charity. So those are things, again, I don't want to go through the technical side of it, but it definitely does require some attention. Donating life insurance policy. Again, if you have an old policy, it's a $250,000, $500,000, $1 million policy, you can get an actuarial valuation on that policy and donate it to Holy Blossom and get a charitable receipt. And going forward, your premium payments are considered charitable donations, and you'll get a tax saving for that every year as well. I just did this with a couple. They had a $250,000 insurance policy. They donated it to their charity. They received an $87,000 valuation on it. That saves them $43,000 of insurance, and they're recognized for giving $250,000 to the charity. Another way is donating a new policy. If you know you're going to have a tax bill, your estate tax of $1 million, consider getting a $2 million life insurance policy for pennies on the dollar. Donate the $2 million on death to the charity, and that wipes out 100% of your $1 million tax. In which case, you remember if you're giving $2 million to charity as opposed to $1 million to the tax department. Or very simply, just change the beneficiary on your current insurance and include a certain dollar amount or a percentage to Holy Blossom, not to St. Joe's. So please don't read that last line. The big secret is life insurance can be owned and paid for by a private foundation or a donor advised fund. You might have a donor advised fund over at the Jewish Foundation of Greater Toronto where I'm a trustee. That donor advised fund can actually own a life insurance policy and pay for the policy and be the beneficiary of the policy. So you can actually create a great amount of charity just by using the money you've already paid taxes on that you've got a charitable benefit from. Other giving strategies, just to touch on a few, we've actually identified over 20 strategies better than cash and checks and Visa cards in order to create better gifts. But one is a charitable gift annuity. If you need income, you could actually set something up with the shul where, let's say you give $100,000 and they'll give you a $6,000 income from that in perpetuity. Plus you'll get a charitable receipt for a portion of that amount as well that you donate. So that's something to consider. CPP philanthropy. Everybody starts receiving CPP when they turn 65. In Canada, that works out to about $26,000 per couple. Most couples that I meet don't need that money. So they pay taxes on it, they reinvest it, and they pay taxes again. If you're philanthropic, you can take that CPP and you could acquire about a $1.5 million life insurance policy. If that's owned by Holy Blossom, then your CPP is considered a charitable donation. So you pay no taxes on your CPP, but the Holy Blossom now has a $1.5 million legacy gift. Alternatively, you could take the CPP, get the $1.5 million policy, pay the taxes on the CPP, but donate the policy on your death to Holy Blossom, which would save your estate $750,000 of tax. Or the last way is take the CPP, get the $1.5 million policy, and make your children the beneficiary of that and donate your registered assets to Holy Blossom that would have been taxed at 54%. Your kids are up by 50% and Holy Blossom gets a very nice legacy gift. You can also get something called ROP, Return of Premium Life Insurance, where you have an insurance policy, the beneficiary being Holy Blossom, but on death, all the premiums you paid for that go back to your family. So it was just a timing issue. The Gift Maximizer is a way where you can actually benefit from a life insurance policy while you're alive, where it can actually produce an annual income to Holy Blossom plus a legacy gift when you die. And finally, Policy Preserver. In Canada, there's about $7 billion of term life insurance policies that get canceled every year because they become too expensive or people don't need them anymore. You could, if your health has gone awry, you could actually convert that policy into a permanent policy and donate it to a Holy Blossom and get a sizable charitable receipt for that and create some good from something that you weren't paying too much attention to. We see that there are 4 kinds of givers. You know, some people want to give, they want to be anonymous. Don't put my name anywhere. Other people want to do it because they want to set an example for others to follow in their suit. Others want to be remembered and be put on the wall or some naming rights. But also there are others that realize philanthropy is great for business. It's a great thing to be philanthropic. And there are ways to be philanthropic at a very small cost to build your brand. Here's an example of a gift that we created with St. Joe's Hospital. A nice young couple gave $1 million charitable life insurance policy. And I won't tell you, but it only cost them $3,500 a year after tax for 20 years to give a $1 million gift. Okay, that's the power of using insurance. And they'll recognize you as $1 million giver at a small cost. And here's just an example. You know, considering $1 million life insurance gift for your family. You can see here, based on these ages of 30, 40, 50, and 60, on the right-hand side in yellow, that's the after-tax cost that would be your after-tax cost on a single life, not on a joint life, but payable for 10 years only. So for 10 years only, that's the cost. If it was a joint policy on a husband and wife, these rates could be lower by up to 40%. So those are the types of things that you should definitely be paying attention of. Last thing I want to just say is, I'm sure everybody on this call knows the name of their grandparents, but how many people really know the names of their great grandparents? Very few. So this is a picture of my great-grandparents, Liba and Aaron Gross, in 1934 in Poland before they died in the Holocaust. Imagine if on January the 1st, you received an envelope in the mail and inside there was a check for $10,000 from your great-grandfather. Do you think you'd remember their name? Well, with proper planning, there's ways to be able to create that kind of a legacy. And they say that the apple doesn't fall far from the tree. That's when the weather conditions are perfect. But when it's windy, the apple is far from the tree. And when there's a tsunami like there is today in the digital world, the apple doesn't even know it comes from a tree. There are two ways to pass around these legacies, these values to our kids, and more so to our grandchildren. That's through going to shul, and that's also through charity. Those are the ways to pass it along. So I really do encourage people to look into how do you want to be remembered, and then look for ways to do it more efficiently and create a legacy that would be great for your family. Next steps, I have something called the 72-hour rule. If any of these ideas made sense to you, speak with Ellen. I'm very happy to arrange a no obligation meeting to discuss your family's legacy plan to help you do something great. Consider your own Holy Blossom legacy gift, learn about it, but don't ignore it. There's just too much writing on the line, and there's so much good that you could be doing for you and your family. And with that, I will say thank you very much for listening, and I'm now going to pass the microphone on to Daniel, correct? Did I
Yes,
pick that
please.
right? Great. Thanks very much. I'm just going to get off the screen share. Sorry. There we go.
Okay, I'll jump in now. Thank you very much, Mark. A brief presentation. And I wanted to just basically start off by saying estate planning is something we all know is important. However, not enough people actually implement one. We all get busy and say to ourselves, I'll get around to it when I have time. Generally, the more assets you accumulate over your lifetime, it becomes even more important to have an estate plan. This is due to the fact that an estate will have more items to manage and the tax liability could be significant. So today's session is showing some very powerful estate planning tools in the form of donating appreciated securities and using life insurance. And Jessica's going to talk afterwards about the importance of a will, among other items. My name is Daniel Wilson, and I'm a principal in the tax group at Siegel. As a member of the Holy Blossom Board of Directors, I'm delighted to be part of this very important seminar. I'm going to cover the basics of taxation at death and then discuss the two types of personal trust that exist. The final two topics are closely related, so I'll provide you with some background information on graduated rate estates and then discuss charitable giving on death. Okay. So we've all heard the expression that there's the two certainties in life are death and taxes. From my experience, when these two topics are combined, it can result in a very large tax liability if minimal planning has been completed. Well, why is that? Well, on death, there's a deemed disposition of all capital property at fair market value. This treats all accrued capital gains as being realized. Now, as many of you know, and Mark just mentioned, the principal residence exemption can be claimed on a home. This can shelter capital gains tax on this property, which is one of the most generous tax benefits available in Canada. But how long this will continue, well, we'll see. But capital gains tax will still have to be paid on any other property that you don't designate as a principal residence, such as a cottage. What about your portfolio investments and private company shares? Well, there'll be capital gains tax on those assets. The fair market value of a registered retirement income fund, or RIF for short, will be brought into your income, and that gets taxed at a high rate. And as Mark mentioned, for an Ontario resident individual, taxable income over $220,000, you're looking at tax at 53.5%. And this often is one of the biggest tax items on death. The main exception to these rules is if property is left to a surviving spouse or a common law partner. In that situation, the property is automatically transferred at cost, resulting in no additional tax. The estate, as well as each beneficiary, acquires property from the deceased taxpayer at the fair market value at the date of death. So I'm going to talk about personal trust now. Now, at a very high level, there's two types of personal trust that can be established. The first type of trust is called an inter vivos trust, and it's set up during an individual's lifetime. And usually the purpose of setting up an inter vivos trust is to transfer the benefit of owning assets to certain individuals, such as children, without actually passing control of the assets to them. A common example is a family trust, which I see frequently with clients that own private companies. An inter vivos trust generally pays tax on all income at the top federal and provincial tax rate for individuals. Now, the second type of personal trust is called a testamentary trust. This is a trust or estate that is created upon the death of an individual. It is taxed much in the same manner as an inter vivos trust. Now, prior to 2016, testamentary trusts were allowed to access the marginal tax rates available to individuals. As a result, planning strategies were used to take advantage of the potential for a beneficiary of a testamentary trust to see a reduction in their overall tax burden by having two sets of graduated rates, the trust and their own. I can recall on a large estate that I worked on, testamentary trusts were set up for each of the 10 grandkids. Now, like many good tax benefits, this came to an end. Effective January 1st, 2016, testamentary trusts no longer had access to graduated tax rates. Now, the only exception to this are graduated rate estates and qualified disability trusts. Now, I'm going to discuss graduated rate estates shortly. A qualified disability trust is a testamentary trust established for the benefit of at least one individual who qualifies for the disability tax credit. The main takeaway from this is that testamentary trusts no longer get their own set of marginal tax rates, similar to individuals. So please check your wills to see if it mentions establishing multiple testamentary trusts. If it does, and the primary reason was for tax purposes, you should revisit this since that benefit has been largely eliminated. So the next topic I want to go to is a graduated rate estate, or GRE for short. Now, I think it's important to start off by saying I've listed the conditions that need to be met to satisfy the definition of a graduated rate estate, or GRE. The main points I want you to know is that a GRE only lasts for 36 months. There can only be one GRE, which must be designated in the trust tax return. A GRE is not a separate trust established in a will. Instead, it arises out of the estate residue at the time of death. CRA has commented that an estate includes all worldwide property owned at death. Another way to view it is it's the estate assets before any allocation to a separate person or trust. Now, in reality, there could be multiple wills with different executors and property located around the world. Therefore, coordination is important to ensure that only one estate return gets filed as a GRE. So on the next two slides, I've listed the benefits that are associated with the GRE. It's listed for information purposes only since our time is limited. And I encourage you to review these benefits since they apply to anyone who's passed away after 2015 and where the estate assets haven't been distributed. And you'll notice that many of the benefits for GREs are the same benefits enjoyed by individuals. So what happens when the GRE comes to its conclusion? Well, once the 36-month period ends following death, the GRE reverts to a normal testamentary trust. So on this slide, I've listed some of the implications on the transition. Now, unlike the terminal return where there was a deemed disposition of all property at fair market value, this doesn't happen at the end of a GRE return or at the end of the GRE period. Therefore, you won't have to worry about income tax that's triggered on the accrued gains. Instead, what you'll have is some extra filings of T3 trust tax returns due to the deemed year end and the new calendar year end date. This will make your accountant happy. As a planning point, it's good practice to have a clause in the will that allows the executors to use the entire 36-month period to administer the estate. We're now going to focus on charitable giving on death. Now, I wanted to start with the old rules, which were pre-2016, and they were pretty restrictive. Now, if the will specified that a gift was to be made for tax purposes, it was deemed to have been made by the individual immediately before death. The donation tax credit could be used in the year of death or the year before death. Now, this created some problems. As an example, there were situations where taxable income was much higher in the estate. If the individual could not utilize the donation tax credits, they were trapped in the terminal return and the estate could not access them. Another problem related to the timing of the donation and the changes in value. let's say an individual donated public company shares that increased in price over 1 year between the date of death and the date of donation. Well, the tax receipt would be issued and showed a larger amount than what could actually be claimed on the final return of the individual. Now, under the new rules, there's a lot more flexibility for claiming the donation tax credit for deaths after 2015. Donations made by the will and by the estate are now deemed to have been made by the estate at the time the property is transferred to the charity. The estate can then allocate the donation among any of the estate's taxation years in which the donation is made, any earlier year of the estate or the last 2 taxation years of the deceased individual. Now, if a gift is made between 36 and 60 months following death, the estate can carry back the unused donation credits to any prior year in which the estate was a GRA. Now, I'm going to briefly talk about the tax implications of owning private company shares at death. And this is a big deal. So if you know someone or if you have private company shares, it's important that post-mortem tax planning is undertaken right after death. And the reason for that is because there's 3 levels of taxation. First, there's the tax on death. Second, there could be tax on the sale of the assets in the corporation. And third, there could be tax on the distributions from the company in the form of dividends. Now, one of the post-mortem tax planning options available occurs in the first year of the estate. Here, losses are carried back to the terminal return to reduce taxes from the deemed disposition on death. Now, if you're redeeming shares in that first year, you could have a large tax liability from a deemed dividend and very little tax in the terminal return due to the loss carryback. So this extension of the donation tax credit to 60 months following death can allow an estate to reduce taxes from the first year of the estate. I've listed some planning considerations to take away. First, make sure that you review your current will to see if it reflects your intentions for planned giving. Second, the donated property must be property that was owned by the deceased at the date of death or property substituted for that property. Last, you can't use new funds such as a loan or even dividends to fund the donation. So make sure it is that property that was there at the date of death. That wraps up my presentation. So I will pass things on to Jessica for her session.
Good evening, everyone. So I am going to briefly summarize for you the various ways one can provide for a charity or charities upon death and comment on what you should be thinking about if this is something you want to do. So to start, the most important thing to remember is that if you want to make a binding gift to charity and you want your state to see the benefit of that gift through a charitable donation tax receipt, the gift has to be expressed in your will. Some of my clients often tell me, my kids know what my wishes are, they'll do the right thing. And unfortunately, even if the children receive the funds from the estate and ultimately end up donating those funds to charity, the child will receive the charitable tax receipt and the estate won't. And as we've heard this evening, it is often very important for an estate to have access to charitable donation tax credits because there's often a very large tax liability within the estate. So once an individual has determined that they are motivated to leave a gift to charity in their will, how can that gift be structured? So there's a few things to consider. And the first one is specifying the purpose of the gift. So for example, the most basic way to leave a gift to charity is to simply specify the charity and specify the amount. If you do that, the gift will be made to the charity and will be used for a general purpose, meaning that the charity gets to decide where to use the funds. If there's a particular program or initiative within a charity, say for example, the building fund at Holy Blossom, you can name the charity, you can state the specific purpose and state the amount. However, my only caution with this approach is that you need to be certain that the gift that you're leaving and the purpose specified can actually be fulfilled. So in these situations, I usually recommend to my clients that they approach the charity to make sure A, that the way the program is described in the will is in fact the way the program should be described, and that B, the charity will be able to use the gift in the way the client envisions. If the charity can't use the gift in the way it's been described in the will, and there's no other saving provision in the will, you run the risk of having the gift fail entirely and no gift being made at all to charity. As an example for this, I recently acted on an estate where the deceased left funds for an organization to create a reading room for children. And it was a large, sizable gift, but upon death, the charity had to decline the gift because they had neither the space nor the resources, even with the money that was being left, to create this reading room. And as a result, the gift failed. There was no saving provision in the will. And in fact, not only did the gift fail, but the executors have had to spend a lot of money on lawyers to sort out where the gift goes, which has ultimately had the effect of depleting the estate assets for the other beneficiaries. Not a great outcome for anybody. If, for example, what you want to do is, leave a large sum of money because you want some large capital improvement project to be undertaken, really the best sort of way to approach it is to approach the charity in advance and maybe even enter into a gifting agreement with the charity that really sets out the parameters for how much the gift is going to be and how the charity is going to use it. That gifting agreement can be referenced in the will. It's a contract, it's binding on both parties, and a really great solution if what you want to do is make a very sizable donation for a large capital improvement, like a new wing or something like that, or even a room or something. So once you've decided what the purposes are going to be, what the purpose of the gift is, obviously the next thing is figuring out how much of a gift you're going to leave. So in a will, you can either structure a gift as a fixed gift of cash or marketable securities, or a combination of both left to the discretion of the executor, or a share of the residue of the estate. And when I say residue, I mean after you take the total assets, after you've paid off all liabilities, including funeral expenses, taxes, what's remaining, that's residue. Or if you want to leave the gift via RRSP, RIF, TFSA, or life insurance designation. If you make a gift to charity of a fixed amount, so long as there are sufficient funds in the estate, the executor makes the gifts, charity says thank you, everyone walks away happy. If you make the gift to charity as a share of the residue, meaning a percentage of what's left over after everything's paid out, the charity will have visibility into what the total assets of the estate were and what the liabilities were, because ultimately they have a right to see how the executor has arrived at what their share is worth. If you make a gift to charity by naming them as the beneficiary of a registered fund like RRSP, RIF, TFSA, or life insurance, these amounts are generally paid out much faster than gifts in a will, because you don't have to wait for probate to have the proceeds paid out, because they're not treated as an estate asset. And therefore, the recipient of them does not have visibility into what the estate assets were, because they're receiving them sort of as an outside from the estate. I will note though, if you're planning on making a designation of a charity like Holy Blossom through an RRSP, RIF, TFSA designation, life insurance, you can do it in a will and it's totally binding at law. My only caution is that you should let the financial institution know that you have made that designation in the will, because typically what happens is a financial institution, when someone dies, pays out the proceeds of the policy based on what they have in their system. And they don't always ask to see a copy of the last will to confirm if there was a change in designation. So we've discussed the purposes of the gift, discussed the amount. Now, the last decision is whether or not you want the gift to endure over many years, or you just want it to be a one-time shot. If you want it to endure over many years, you can create, obviously a private foundation, but that's very cumbersome and expensive at the outset. And so what instead you can do is open what's called a donor advised fund, which simply put is a sort of like a private foundation, but it operates through an established charity. And the charity would allow you basically to create a fund that grows over time, tax-free, administered by the charity, but allows you to direct where the money goes. So for example, the Jewish Foundation through the AJA is a great example of a charity that that provides donor advised funds. And they do a wonderful job administering the funds, low admin fees, and you can donate the money anywhere. It does not have to go to the UJ. It can go to any qualified Canadian charity. Donor advised funds are also a great way to get children involved in philanthropy because they can assist in the decision-making process during lifetime. And upon death, the contract, the donor advised fund gifting contract, can advise who are going to be the succession decision makers. So you can make your children the succession decision makers as to where that pool of money, how it's going to be split between charities on a go-forward basis. Finally, if you can't decide which charities you want to benefit, maybe it's Holy Blossom and maybe you can't pick the others, or you can't decide on the total amounts today, you can give your trustees, rather your executors, discretion if you set some parameters to A, select charities that upon death, and B, select the amount. Selecting the amount is often really great where one does not know what their tax liability is going to be, which usually you can't sort that out, but you want to offset it in some way. You can give your trustee, your executor's discretion to make a charitable bequest to a particular charity up to an amount of X, and that will help eliminate the tax liability because they can make the decision once the tax liability is known. Finally, I just want to close briefly with a word of caution about updating wills. So many people will have done a will and they may be holding the original will at home, or they may have a photocopy of it. If you decide after your will has been signed that you want to make an amendment, say for example, to add a charitable bequest to Holy Blossom or any other amendment really, please do not simply take out your copy of the will, add a note in the margin and initial it. That is not binding and will not be upheld. Similarly, please don't leave a side note saying, oh, I want to add the following bequests here. Thanks, love mom and dad. Again, not binding and could lead to a whole bunch of expensive litigation. The best thing to do if you want to update your will is to call a lawyer, either the lawyer you worked with, another lawyer, whoever it is, and either do a new will or a codicil to the will and have it properly executed in the presence of two witnesses. I can't stress that enough. Though Ontario's legislation is sort of relaxing, we still have a two-witness requirement that is not going away anytime soon. And that is all for my formal remarks.
Thank you so much to the panelists. That was fantastic, fulsome, and a lot to digest. I would like to apologize for the mismatch in timing of Daniel's slides. They did not get put up in time, so his words did not match his slides. We are happy, though, if to send out copies of Daniel's presentation to all of the registrants so they can coordinate with what he was saying. We are now going to move to the question and answer section. We've asked participants to send in questions in writing, and we have a few. The first question is how to donate such that there will be an ongoing, lasting legacy. And David has agreed to answer this question.
Thanks, Allison. In the last presentation, you heard about donor advised funds, for example, at the Jewish Foundation of Toronto. And that's probably the best way to do this. You can give a capital gift and advise that your charity of choice be given funds over a period of time or as a lump sum. If you want to make a naming gift, for example, a space at Holy Blossom in our renewal project as a legacy, you can do this through life insurance, as Mark talked about. You can do it by gift of securities on death. Everybody's circumstances are a little bit different. I think what we've heard tonight are a lot of ideas. As always, when we get to a lot of money and law, the devil is in the details. It's very important to get these things right. So one thing I would say, if you're going to pursue any of the strategies that the four of us have talked about tonight, don't try this at home, folks. speak to your financial advisor, your insurance advisor, your lawyer, or your accountant, or your banker, and make sure you do it right. There's a lot of ways to do it.
Thanks, David. That was great. Second question is, what are the pros and cons of making one large donation or several smaller donations to a variety of charities? And I think, Mark, you were going to answer that one.
Yeah, I think it really depends on what charities you're passionate about. Certainly there are people who like to spread it around, and that's fine. But then there are people who have a real passion for particular pet charities or causes. And clearly, if you make bigger donations to those, you can have a much bigger impact with those causes as opposed to spreading it out to a larger amount. So it really depends on what's important to you. And as David said, it requires having a conversation and discussing that. But the key thing is definitely setting it up. That's the most important message that we pass along.
Okay. Thanks, Mark. The next question is for Daniel. Could you talk about the transfer of a RRIF, and Registered Retirement Income Fund, to an RDSP, a Registered Disability Savings Plan?
Sure. Basically, to start off, a Registered Disability Savings Plan, it's commonly referred to as an RDSP. It allows a plan holder to contribute up to $200,000 to a tax-deferred account on behalf of the beneficiary who's 59 years of age or under and qualifies for the disability tax credit when the plan is opened and when the contributions are made. Now, proceeds of a deceased individual's RRIF, Registered Retirement Income Fund, can be transferred on a tax-free basis to the RDSP of the deceased individual's financially dependent child. Now, the maximum rollover amount into an RDSP is $200,000. Now, you have to consider all contributions that were previously made into that plan, the RDSP, because that will reduce the $200,000. And the other thing that you have to keep in mind is a grant will not be paid into the RDSP on amounts that are rolled over. But the maximum amount is $200,000.
All right. Thank you, Daniel. And the fourth question we have is a two-parter for Jessica. What are the pros and cons of establishing a foundation for giving? And part two of that is, what type of account can I open for my children to be able to access for emergencies that does not have to go into probate upon my death?
All right, so the pros and cons of setting up a foundation, there's a lot of pros and very little cons. It ultimately depends on how much money you want to donate. So a private foundation has very expensive costs at the outset, right? You have to pay a whole bunch of money in legal fees to set up the foundation. There's annual charitable filings, annual management. You have to have someone manage the money. So private foundations are really for people who have very large sums and really want to manage those sums themselves for charity. Donor advised funds, which we've spoken about a lot tonight, are a great alternative to people who don't necessarily want to establish a foundation with $1 million, but maybe they only want to start with $10,000, $20,000 and then maybe add over time. Every time you add money to the foundation, you get a charitable tax receipt. And if you want to continue giving on death, you can leave a large sum to the foundation on death. So really, there's a whole bunch of pros, very little cons. I would say the only con is that if what you want to do with your money is, have it grow and then leave a very large gift to a particular charity so that they can undertake a capital project. Unless that's written in the donor advised gifting agreement, you're usually spreading money sort of in perpetuity over many charities versus giving a very large sum to one. So that was the answer to the first question. Your second question has to deal with creating an emergency fund that doesn't require probate on death. Unfortunately, my answer to this question, and I hate to be the wet blanket, is you can't have your cake and eat it too. So briefly, without getting into the technicalities of the law, because this area is complicated, if a parent adds a child to a joint account, that there is a presumption at law that the child is only holding the account in trust for their parent. And so by extension, on death, they are holding it in trust for their parent's estate. What that means is that you're supposed to declare the value of this account for the purposes of probate. And even though the bank will let that surviving child use the funds because they're a legal owner in the bank documents, beneficially, the account isn't theirs. It's the account of the estate. And if the purpose of doing this is because you want your child to have easy access to funds for like funeral expenses and taxes and to pay, maintenance fees on the condo, those are ultimately all estate expenses, which only further supports the position that those funds are really belong to the estate. It's not a terrible idea if you don't want your child to have to fight with a bank to get access to funds for things that are needed for the estate in short order, but you don't avoid paying probate fees on them.
All right, thank you very much, Jessica. That is all we have for the written questions. So I think we'll conclude here. An enormous thanks to all of our panelists. That was terrific. I imagine there will be questions following this. If any of them keep you up at night, please feel free to write to Ellen, and we will endeavor to pass them on to our panelists and find the answers for you if something comes up subsequent to this webinar. I'd also like to thank our attendees, our registrants, for joining us. And I hope you've enjoyed our webinar on Giving Smarter. Good night, everyone. Thanks so much.
Night, stay safe and well. Thank you.